things are disappearing off of the exchanges at the highest levels. But I mean, if you've been paying attention for just a little while, people should have been expecting this. Volatility index last week, was up for 6 straight days in a row. And since February, the volatility index is up over 45%. Well, I mean, people need to be paying attention to that. People need to be paying attention that last week I was screaming that the hedge funds, that their participation in the Mag 7 was down to a 22-month low. People need to be paying attention that, institutional capital has been rotating from risk on to risk off. Look at all the insiders that they have been a 6-to-1 selling to buying. Look at the fact that, I mean, this is actually kind of crazy that on February 20th, Jamie Dimon sold $234 million worth of JP Morgan stock, the most he's ever sold. 2 days later, on the 22nd, Warren Buffett announced that he had $334 billion in cash, and of that, $279 billion in U.S. Treasuries, way more than the Federal Reserve holds. And then 12 days later, the NASDAQ 100 crashed 11%. Could that really be a coincidence? Do you think that, that they didn't know that this was coming? And, part of me feels that this is planned, that this is what they want. This is what Trump wants. I know that sounds counterintuitive, but he wants people to emulate what Warren is doing. Warren is selling stocks and buying treasuries, massive amounts of treasuries, which lowers the 10-year yield. Because we have just in the next 6 months, $7 trillion in treasuries that are coming due that we have to refinance. And if we refinance them at higher interest rates, it's very painful. So the only way to get the rates lowered would be to incentivize people to move from risk on to risk off, sell stocks and move to U.S. Treasuries, which will then lower the 10-year yield, and then he can go to the Jerome Powell and say, you got to lower the federal funds rate to drive the short-term rates down because the economy is in trouble. That's the only way we're able to, mitigate the pain in the refinancing of our debt. But I can't remember a time where we've seen such a rapid shift from risk on to risk off. In November, with the Trump euphoria, it was massive risk on. Everyone was buying Mag 7 and Bitcoin and the stocks within the Mag 7, and as hope springs eternal. But to give you an idea, if people are paying attention, the Russell 3000, which encompasses large caps, small caps, and mid caps, if you take the average stock of the Russell 3000 is down 30% from its 52-week high. That the Russell 3000 is a sampling of the economy, right? It's not the big Dow stocks. It's 6 times the measurement of the S&P. And if you look at the weighting in the S&P, it's ridiculous. You got 7 or 8 stocks that comprise, 30, 40, 50% of the weighting of the 500. So when you talk about the Russell 3000, it's a much broader swath sampling of the economy. They're all down 30% from their peak. So the warning signs have been here. It's just that our media, if they're not watching you and me and others like us, they're missing all of this because they're, it's to the moon and missing what the insiders are doing. And the insiders, the smart money, for quite some time now, since the end of February, anyway, the mid to end February, have all been, exiting stage left quietly. And the fact that this isn't center cut on the newspaper and front page on any financial news station, well, that's what you get with a media that doesn't do anything but create divisiveness and spew nothing but lies, and have been for quite some time. But if you've been paying attention, this to me has been expected. And I think this is what Trump wants. He gave an interview with Maria Bartiromo, and he's like, he avoided the tough question about recession. And even though you look and every indicator is signaling recession, the SAM rule, the SOM rule, the big money into huge influx into money markets, over $7 trillion, that's record. And that's always a sign of recession, as the SOM rules predicted the last 9 recessions in a row has to do with unemployment levels rising or employment levels falling. I think it's 50 basis points below the last I forgot the last month or the last few months. You have the reinversion of the yield curve. All of the metrics by which recessions are measured are all screaming. And then, you have the Atlanta Fed, who just came out 2 weeks ago or less, that was just calling for a 2+% GDP growth for the year. They're now 4% less at -1.5%. They're calling. In just a matter of days, they went from 2% plus, 2.5% plus projection for the year to now -1.7 or 8. So they're saying we are contracting heading into a recession. And so, to me, what we have is the beginnings of stagflation, which is the worst of both outcomes. I'd say that is an inflationary environment, little or no economic growth, higher inflation, higher unemployment, slowing economy. And if people are scared, as that fear takes over from risk on to risk off, and we've seen this massive shift, not just from the mom and pop investors, but the hedge funds have left the Mag 7, the lowest exposure in 2 years to it. That's why you're seeing them getting clobbered. They want everyone to move into the 10-year treasury to lower the rates, to make refinancing easier, and to incentivize Powell to lower rates as well. So yeah, there's more of this to come. We haven't experienced a material correction in quite some time. Every time it does, they come in and they pour more gas on the fire. And at some point, these inequities have to be paid for. And that's kind of what maybe Trump understands that and realizes that. I, for one, would be very cautious right now in this marketplace, that everyone's up to their ass in debt. And when you suppress interest rates for 3 decades, you incentivize debt. And well, hey, I mean, shit, I can buy that the nicer car than I wanted to because I can get 60 months 0% interest. And we can spend an extra $350,000 on that house because, well, rates are so low that we can do that. That's what they have been for a long time. Not at currently, but that's what they were for a long time, at the zero bound federal funds rate and low mortgage rates. And so you've incentivized all this debt, and that works while you have your job. You lose your job, you're dead, or the economy slows down and they start making layoffs. How do you service that debt? That's why they're so afraid of a recession. Recessions are actually good things, and we've been told that they're bad. Recessions are like a brush fire, right? They're never fun, and bad things happen. People die, or animals die, and trees die. But you come back a couple years later, and the forest is stronger than it's ever been. That's Mother Nature's way of cleaning out the excess. And every time we've headed into any type of a slowdown, they've come in and pumped more money into the system and lowered rates, which just made things worse ultimately. And so one of these days, this will be something that has to fully express itself. Is this the beginning of it? Don't know, but they certainly don't want a recession, because it just means it's that much harder. They'd much rather have inflation so that the debt becomes easier to handle, watered down money. A recession and or depression where things slow down, the debt just collapses upon itself. And this whole thing is like a balloon that's been blown higher and higher and higher and higher, and you poke a little hole in it, and they're still trying to blow air into it to keep it from going, but heaven forbid it starts to deflate, the whole thing collapses upon itself. And that's what they're afraid of. Well, there was the Pulaski Savings Bank in Illinois that failed earlier this year. Said it was fraud related. We haven't seen any. That's been the first here in 2025. But the one in Lindsay was bailed in, which is a scary thing. There's over 60 plus banks, I believe, on the troubled bank list that more or less says if things don't change, they'll collapse. I think we have definitely not heard the end of bank consolidation, bank failures. I think keeping more than the FDIC limit at any bank is as dumb as a mud wall. And I say that with respect to those people who haven't really understood what a bank bail-in is. But ask the folks in Lindsay, Oklahoma, where half of their uninsured deposits are gone. And if that means you have $1 million in a bank in Lindsay, Oklahoma, $250 is insured, that leaves $750 uninsured. Well, they were given half, and they're not even supposed to get that of the uninsured deposits, because they only had 7 million in uninsured deposits, not the billions that Silicon and Signature had, including Oprah Winfrey's money and the tech startup money. But that means of that 750, they got 375, which means 6.25. they got 6.25 back of $1 million. That other 375, might as well kiss it goodbye. You're never going to see it again. And if you do, they have up to 4 years to pay you in the form of bank stock of the new stock, the new bank. And that's only if the assets match the liabilities for the reason they went out. Well, if you go bankrupt, typically your assets are less than your liabilities. So in essence, it's gone. Now, the law says that anything over the 250 insurance limit is gone. So, they can consider themselves lucky. But no, I think that the banking problems have not gone, and they're so systemic to one another. You see a good-sized regional bank collapse and bailed in, it would create a run on the banks overnight. So, it's no longer doom and gloom and supposition. It's happened very quietly, and the media does, as usual, a horseshit job of telling us about Bank of Lindsay, Oklahoma. You ask any of your friends out there, no one's heard of it, but try and find it. It's even hard to find. Go to the FDIC website, you'll find it, and then Google Lindsay, Oklahoma bank failure, and you'll find a little article from a regional Fox News channel that talks about it, but it wasn't center stage like Silicon and Signature who were illegally bailed out. So everyone thinks, yeah, the banks get bailed out. No worry, everyone got their money back. Well, bullshit, and wait till a big bank fails in a very, deep recession where loans aren't being paid back. And that's another reason he probably wants rates to go down, because if rates continue to move higher on the 10-year, you're putting greater and greater and greater strain on these banks who once again went back into the water and making the same mistakes again, buying fixed income treasuries, figuring that they can't go any higher, right? Well, they have been. So I guess we'll see. But no, I'm not convinced that the banking problems are behind us, not even a little bit, actually.